Question number 4 says discuss all the tax consequences supported by calculations for the events and transactions related to Jacob Pillay for the period up until the 1st of December 2023 and ignore any VAT consequences. So this is up until the date when he emigrates. Now this is a discussion question, and as you'll see if you look at the solution, what I've also done is at the bottom, just for illustrative purposes, I've also done this in a calculation form. And what I want you to pay attention to, especially if you're struggling with discussion questions, is to go and see, and basically everything that I do in calculation form, I just say it in words. So the rental income from March until November, he's entitled to 50% of it because it's vested. He'll be taxed on that. You'll see those are all the discussions. All right. So what I'm going to do is I'm going to talk you through. You've got the solution in front of you. I'm going to remind you of the different parts of it and how it all comes together. Okay, so a couple of things. Let's go down to Jacob and just remind us. So he emigrated on the 1st of December. So his tax year starts on the 1st of March. He's a resident until the 1st of December. So up until the 30th of November, he's basically a resident. From the 1st of December, he's a non-resident. Okay, that was 90 days that he's a non-resident. During the time that he's a resident, he's taxed on worldwide income. After that, he's only taxed on income from a South African source. On the 30th of November, Section 9H applies, and all of his assets, he's deemed to sell all of his assets immediately at their market value before he becomes a non-resident. So that's included in this period. Okay, so let's talk about the different aspects, and I suggest that you just start from the top and work your way down. Right, so the first places where we see information about Jacob is in the trust. Now, in the trust, I'm just going to clean this up a little bit. These are the amounts where Jacob received something. And then also he has a vested right to some information. So let's go and start with it. So the first thing that we talk about in here are the local dividends. These local dividends, that 90,000 was, he has a vested right to it, but you'll remember that this was paid on the 20th of January 2023, so it's in the next tax year, or not in the, it's in the periods rather when he's a non-resident. Now, why did I sound like I'm being a fool here and saying it's in the next tax year? I'm not completely wrong. If you'll recall also, one of the implications section 9H is it says you treat it as if your tax year, it's a shorter tax year, ends there and then a new one begins. Okay, so that's what I'm referring to there. Okay, so that 90,000 was in the period after 1 December. In any case, it would have been taxed in Carl's hands because he was a non-resident. Jacob was a non-resident at that point in time. You'll remember under section 7.8. Okay, then the net rental income, 675. That 675 is 50% of the 1350. Now, if you add these two amounts up, you'll see it's 1350. Jacob is entitled to how much of that? Jacob is entitled to 50% of that amount. So, he's entitled to 50% of the 650, which is for this period which we are looking at, and then he's entitled to 50% for the next period. So what happens to that 650,000? That period will be taxed in his hands. He's a resident, earned it from the trust. Section 25B applies. So if you're going to look at the situation here, Section 25B applies, he'll be taxed on the 50%. Okay, easy as that. Then we have the foreign dividends. Okay, the foreign dividends. He received 147,000 for it. When was the foreign dividends? When did it get paid? The foreign dividends were paid on the 20th of December 2022. That's when the trust became entitled to it. This required, again, asks us to do it up until 1 December. So this is not in the period that we're looking at. I will just mention to you again what would have been the case there. That's a foreign dividend. He's then a non-resident, so it's a foreign dividend earned by a non-resident. So there would be no implication. Then the local interest. That 21250, right? It's earned evenly throughout the year. So 21250 times 90 over 365 is the period when he's a non-resident, and 21250 times 275 over 365 is the period when he is a resident. This period over here is taxed in his hands in terms of section 25B, because we asked the question, was the donation, is the donor alive? Yes. Does any of the section 7s apply? Well, when Jacob is a resident and he hasn't immigrated yet, none of them apply. So he's taxed on it. Right, the beneficiary is taxed on it. And then there's obviously the normal interest exemptions. So that's where you'll see what they talk about here. He has a vested right to 25% of the income. Look at the mark. It's just stating things. The local interest is a donation. But the local interest on foreign dividends is not, right? So there we talk about he gets his share 275 over 365, and it is then exempt. And the question also you can see talk about this next part, same story there. This is local interest again. So the 23,000 times 275 over 365 he gets taxed on. Okay, so that's Jacob's income. Is it from the trust? No. So what also is there? The sale of the flats. The flats were sold on the last day of the tax year. So again, that's after 1 December. So our required only asks us up until 1 December. So we're not concerned with that. Okay, what else do we know about Jacob then? Right, Jacob is the shoemaker. So what else do we then know? He does the following during the period 1 March to 30 November, which is what we're looking at. He purchased raw material of 800,000. So you will say that 800,000 will be allowed as a deduction under section 11A. The 12,000 he pays his assistants, he'll claim that also under section 11A is an expense incurred in the production of income, wages paid. The 1.5 million that he sells it for will go into gross income. Then section 31 will apply. Section 31 says if you are a connected person to a non-resident and there's some transaction which is less than market value, which means someone doesn't pay enough tax, you need to fix it. So that difference of 2.2 million minus 1.5 million, that's 700,000. What will happen to that amount? That amount will go into his taxable income, into his gross income. That's called the section 31(2) adjustment. You'll recall that. That extra 700,000, there's then the section 31(3). That 700,000 is treated as if he made a donation. Right, a donation of 700,000. You will then consider all of the exemptions. If he hasn't used his annual exclusion yet, he gets 100,000 annual exclusion from that. And that 600,000 there is then subject to donations tax. Remember, if he was a company, then this would have been treated as a dividend in specie, so it means the company would have to pay dividends tax. If you can't recall this, please go back and study that. Not if you are a level 1 student. But everybody else, please do go and study section 31 if you can't remember it. And the solution also talks you through it. And then what else happens? We have to talk about the immigration. So in terms of section 9H, remember, you treat it as if you sold all of your assets at market value, except for immovable property in South Africa. So what happens here? The shares, they treated as if they were sold for 5 million. Their cost was 100,000. So that's a big CGT, right? See, They treated as if they were sold for 5 million. Base cost is 100,000. Personal residence. This is immovable property in South Africa. Section 9H tells you that immovable property in South Africa is not part of Section 9H, so we'd have no issue with that. And then the personal effects will be personal use assets, so there will be no CGT on that. He gets his 40,000 annual exclusion, and 40% of that is taxable. So as you can see there, guys, it's literally taking this solution. Look, here's the shares. You're saying the share is literally what we would write down here. So if you understand the calculation, you just put it into words. So you'll say Section 9H applies, treated as we sold at market value. The shares, the proceeds is 5 million. The base cost is 100,000. Personal effects is no CGT on that. Okay, and I just didn't have it in here now, but you would also, I would have had the residence in South Africa and would have said that's immovable property. Okay, so guys, make sure that you work through the discussion and this to see how this discussion and the calculation support each other.